Good day, everyone. We're here again to discuss another lesson, which is the taxation. Chapter 6, Lesson 3a. Taxation refers to the act of a taxing authority actually levying tax. Taxation as a term applies to all types of taxes, from income to gift to estate taxes. It is usually referred to as an act, and revenue collected is usually called taxation. History of taxation. It is a matter of general belief that taxation are of recent origin, but in ancient time also taxes were levied in some form on sale and purchase of merchandise or livestock. It was all over world. In India, Kautilya's Arts Shastra, which deals with his system of taxation in a real elaborate and planned manner. Tax. It was only for the good of his subjects that he collected taxes from them. Just as sun draws moisture from the earth to give it back a thousandfold. The modern definition of tax. Tax is imposition of financial charge or other levying upon a taxpayer by government or other functional equivalent of the state. The government policy. The organizational history of Income Tax Department starts in the year 1922. In 1961, Direct Tax Advisory Committee set up Direct Taxes Administrative Inquiry Committee constituted and Income Tax Act 1961 into existence, which extends to whole India and became effective from 1st April 1962. Every year, a budget is presented before Parliament by Finance Minister. Most important component of budget is Finance Bill, which contains amendments which are sought to be made in the area of direct tax levied by central government. There are two types of taxes. First is direct tax, second is indirect tax. Direct tax. The taxes whose burden falls directly on taxpayers are direct tax. Example, income tax, wealth tax, property tax, and etc. Indirect tax. Indirect taxes are the taxes in which the burden of paying tax is shifted through a change in price. Example, custom duty, excise duty, sales tax, service tax, and etc. Income tax has two branches, the personal tax and corporate tax. Personal tax is levied on the income of individual, undivided family, and other association of people. Corporate tax it is levied on income of registered companies and corporations. Income tax. It is a tax on the income of an individual or entity levied by government. It was introduced in 1860, discontinued in 1873, and reintroduced in 1880. Personal income tax. Income from all the sources are considered. Certain rebates, deductions, expenditures, insurances are not considered for levy tax. It is progressive. If income increases, tax rate also increases. It is levied on the basis of slabs. Here is the slab for personal income tax. Annual rates for all individuals, Hindu and divided families, age between 60 and 80 years anytime, and age over 80 years anytime during the previous year. Corporate income tax. Rationale for corporate tax is that a joint stock company has a separate entity so taxed separately. A corporation pays taxes on behalf of income of shareholders and dividends paid to them, and each shareholder get a credit till 1960 to 61. Now shareholders don't get credit because entity treat as separate entity. Corporation pays on flat tax rates and it is different for Indian companies and foreign companies. Here is the corporate income tax table. Type of company, total income more than INR 10 million, total income less than INR 10 million. Custom duty and octroi. Custom duty is levied on import and export. From revenue's point of view, importance of export duty is limited. Since 1991, custom duty structure was prompt and now maximum rate of custom duty is 10%. Actually is a tax on goods entering to municipality or any jurisdiction for use, consumption, or sale. Excise duty. It is a tax charged on goods produced within the country. It is opposite to custom duty. Its another name is CENVAT, Central Value Added Tax. Anti-dumping duty. Dumping is said to occur when the goods are exported by a country to another at a price lower than its normal value. This is an unfair trade practice which can have a distortive effect on international trade. In order to rectify the situation, central government imposes it. Sales tax. This is the tax imposed on the sales of movable goods. Sales tax on interstate sale in levied union government and on intrastate sale by state government. Service tax, the tax on paid services you take in service tax. Over past few years, it expanded to cover new services. Few of the major services which comes under vicinity of service tax are telephone, tour operator, architect, advertising, healthcare center, banking and financial services, and etc. Value-added tax. The part of sales tax imposed by state government is called value-added tax. It covers more than 220 items. VAT rates vary based on nature of item and state. Advantage of taxes. It helps to the government in its revenue, which is used to facilitate people of a country. It helps to control inflation. It restricts government to take loan from World Bank. It utilizes public money in social welfare. Disadvantage of taxes. It restricts common people to get extra happiness at some extent. If government misuse tax, we don't have any control on it. Tax evasion and tax avoidance. Chapter 6, Lesson 3b. Tax evasion. An illegal practice of a person or corporation that intentionally avoids paying his true tax, which is illegal and unethical. Tax avoidance. Legal rearrangement of a business financial activities in order to lower the tax liability. It is legal, ethical, or unethical. Tax evasion. Unscrupulous government officials, tax avoidance, accountants, lawyers, financial managers. Tax evasion, understatement of income, overstatement of expense, false or fictitious entries in books, tax avoidance, moving capital or labor to areas or countries with lower tax rates, manipulating the tax parameters through legal means. So this is the computation of tax with corporate tax rates. Why is tax evasion ethically wrong? Compromising the purpose of taxation. Peace, security, just distribution of wealth. Disobeying the government. Disobeying laws, disobeying leaders. Tax avoidance. Ethical or unethical? According to Milton Friedman, admitted that tax avoidance is advantageous in the long run. Tax avoidance may therefore have been essential for economic well-being, while according to Rosario Manasan, said that tax avoidance is similar to tax evasion, loss of government revenue, increase in taxpayers after tax income, perverse effect on the equity and efficiency goals of the tax system. Tax avoidance. Avoiding tax is avoiding a social obligation. It is urged. Avoiding tax have costed the Philippines 360 billion per year. Unethical. That's all for today's discussion. I hope you learned something. Thanks for watching and listening.